Yeah, Chris. So you guys are thinking, is this for your Edmonton place, the one that you just renovated?
Yeah, yeah. You know what? I can just do this. There's the listing. It's in Edmonton. It's in actually a really nice area, Ramsey Heights. And so it's across from some pretty affluent housing. And it's a massive space. It's actually like 1,800 square feet. I even fixed the fireplace. That's my handiwork there.
It looks awesome.
Yeah. So, I mean, it's a pretty big space. Like we did a couple little lipstick things to it, but it's got brand new washer dryer. The appliances, we just replaced the dishwasher. Yeah, the dishwasher, new floor, mostly paint, right? Like the tenants we've had have been really good. So it's a very clean, open space. We had the electricians put in pot lights.
Yeah, it's gorgeous. And this is in that area. Like, I know the area really well. Your tenant demographic is pretty much as good as you're going to get in Edmonton. I have a friend who has a few condos. It might be in the same complex, and has for many, many, many years. And yeah, just the best renters that you can get. So yeah, that way, ease wise, you're good. But with interest rates going up, Jen, you were saying like cash flow is now negligible, and therefore you're looking for like a different strategy. Okay, how do we this up and make it better?
Yeah, I would say there is negative cash flow now on that one. So we're now looking at, because it's probably been listed for maybe a week now.
Yeah.
So now we're starting to think, okay, do we need to think outside of the box if we're gonna hang on to this place, get a little creative with it? Yeah, so Chris had the idea, well, what about corporate rentals? Like, is that something? How do you even find out about it?
Like, I don't know, like, is there further investment here? Do we have to fully furnish the thing, or do we rent that? Or is there a company that provides all this?
Like, is it a bad idea?
So we're coming at this cold, guys. We don't have any information on how to do this, or what companies even provide the service and what's included as part of that, right? So that's what we're trying to get some information from you.
So let's start with, Vancouver and Toronto both have like kind of those apartment in a box type companies where they will come in and just kind of furnish and walk away. We in Calgary, Edmonton, that I know of, don't have that. Although we do have people that we can put you in touch with that have done that, for themselves. And so they know exactly what they're doing in that. You could hire them as a consultant type thing, but yeah, it's going to be a lot more hands-on than just an apartment in the box kind of thing. Secondly, let's hit, talking about, well, do you have to furnish it? Generally speaking, for a corporate rental, you would have to furnish it. The beauty is there's that old thing we heard forever ago that was like, ding, 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 at one of my first investment seminars that I just was like, this sounds amazing. The brick has 5 years, don't pay. And I know people that use this even right now. We have she's like an old client of ours, and she's doing this still. She's puts it on the credit card, furnishes her whole entire place. In fact, now that IKEA has a credit card, she's using that a lot often too.
Well, when we did our suite, we
did the same thing.
We got a Home Depot, 10 grand at Home Depot and 10 grand at IKEA. We didn't spend all of that, but between those two things, we built an entire suite in our basement, essentially, for Tiff's parents to live in. And then the rent that they paid us, which was very small, but the rent that they paid us over the time period that you have that's no interest, we ended up paying it all off. So it was zero money out of our pocket. That's kind of the whole point of it.
Right, because you guys have already outlaid cash recently. If the whole entire point of you moving into real estate is to generate cash,
right? We're just throwing money into these
and not even just on this place. It's actually our other Calgary rental that's been expensive lately. So
right, it adds up like quick. So
fast.
I'm just going to add in a couple of my thoughts, and then Tiff can continue with what she might be thinking. But the general principle that I would use when it comes to whether we should keep a property or whether we should unload a property is, what is today's value, and would I buy it at today's value
and today's rents
and try to rent it out? Would this be a good purchase today? So let's say, I don't know, maybe you bought it for $250 and now it's worth $250, and maybe rents were Well, just tell me if you're okay with saying it.
Yeah, we bought it at 250. When we bought it, rents were 2150, I think. Now we just had the refinance done. No, it came back exactly at 250.
Okay.
And we were asking our realtor to say, hey, there were places for sale. What did they sell for? And two of them just sold for like 234 or something.
Yeah.
And we had just rented it out. The last rent we had was 1900.
So generally speaking, we would say, okay, well, would you buy that now, knowing that it's 250, or that you're going to pay 235 and get $1,900 a month in rent? Would this be something that you would buy?
I think
No.
we've learned enough to be like, no.
But we know we're in an unusual time, because even when we were, doing our best, when things were, how do I put this, to pad ourselves, right? So even when times were good, we went further to reduce our risk by really padding, right?
Yeah.
And that
There's
that
no
wasn't
padding.
enough.
There's
Now
no
there's nothing. Like it's at 7%, it's like it's just not going to come back. So what's interesting is they're saying that Alberta, Calgary and Edmonton is supposed to have this influx of people looking for rent. Like I'm seeing that in Calgary. I'm not seeing it for Edmonton in the same way. That's just my personal experience with the two properties we have. The Calgary one, man, I couldn't bat them away fast enough. I had to increase the rate. And now actually I think Calgary 2-bed or 3-bed in Calgary house is like going for between 25 and 2,900. So we have to bump it again. But Edmonton, yeah, it's not the same. It's not the same. But this is also a condo. However, we did allow pets. That should bring in more people.
Right.
Not really getting the bites. And I even upgraded the photos to be a little bit brighter, look as good as possible.
Yeah.
So not sure what else we can do here if it keeps going. I'm like, do we try and do, both rent it out and see if we can get it sold at the same time? And whichever happens first, that's what we go with.
Yeah, you certainly could. I mean, why not, right? Like just kind of explore your options. So I know one of your questions was what's going on in Alberta. Like, how do you know when to sell? How do you know when, like, are you going to sell? And then, next month it's going to hit and it's like, we sold at the wrong time. Yeah. And you know what, like, even if it was, I think the one thing we have to always remember is it's our like emotion, our mental energy, our physical energy. There's always going to be money we leave on the table. Always. You sell at the height of a market, you're still like, you didn't time it perfect. There's still always money on the table. But like, what's it doing to your lifestyle? So that's a big, huge question. Again, it's that time in the market. If you guys can stay investors for 20 years, let's say that you get rid of the Edmonton property, you didn't make any money on it, you held it, whatever, like it is what it is, right? But it allows you to manage your Calgary property and just sit on it for the next 20 years. Your mortgage gets paid off. You have a property worth this much that was cash flowing or at least taking care of itself and no mortgage on it in 20 years. Are you okay with that? It's not a terrible scenario, but if you hold on, let's say to your Edmonton and Calgary properties, and I don't know that this is what's going on, but if you hold on to both, you hate real estate, you're going nuts, you just can't handle it, and you say, you know what, screw it, we're going to just sell both of them. And in 3 years, you sell both of them, you've got a chunk of change, but nothing life-changing. Did that benefit you? So, I mean, you guys are the ones that know how this is affecting your life.
Cole's notes what Tiff is saying. She's saying keep it and figure out a way to keep it.
Yeah.
Don't sell it.
No,
Isn't that what you're saying? No? Okay, that's what I was getting from it.
Really? Is that what everyone else got to? Okay.
Well, it's all about the long term is kind of what you're saying, right?
Right. But my thought is, if right now it's taking so much emotional energy out of you that you're not going to make it in the long term, it's going to take you out of the game, then get rid of it so that you can.
I don't think it's that, Tiff. I think more what it is how long do we hold on when the interest rates are gonna kind of like
they're gonna stay where they are for a while, is what they're projecting, right?
And all of our buffers have now essentially been drained because we had cash flow positive properties. Now that's like even our Calgary one, $400 in cash flow is now like just maybe break even. And so it's like, do we just need to weather the storm a little bit longer because both of our properties are at the 5-year mark? Or do we have to look at it a little bit differently? Because what I'm worried about is we had the unfortunate luck of all 3 of our properties had refinances like September right now, and the next one's coming up in June. And each one the payments have just ballooned. And we're like, oh my gosh, what do we do? So I'm trying to get ahead of it with the next refinance looming in June. I'm like, do we need to revisit this?
Okay, and are you refinancing and pulling out money, or are you just renewing these mortgages?
We are just renewing the mortgages. We've decided not to pull out money, at least for the Edmonton one, because
So
we
they're-
still
they're-
want to have the flexibility to just get rid of it if we want to.
So just to be clear, they're not necessarily refinances, they're more just renewals of your.
They
mortgage.
are refinances. We've just chosen not to pull the money out of the HELOC.
Okay.
So you are going through the qualification process.
Yep, the full qualification process, but we're just not, we don't need the money for anything really. We already have a HELOC with our home, so we've just used that.
Okay, so I mean, let's, back to basics of whether you keep it or you get rid of it. It all, to me, the answer comes down to how much is it taking out of you? If it is stressing you guys out and it's taking a lot of time and effort out of you, if you got rid of your Edmonton property, it's in great shape. It should sell pretty quickly. Would that allow you to hold on to your Calgary property and move forward with other things that are not going to have you quitting real estate in 3 years because you're just beyond done?
Yeah, at some points we're like, we're just done. We're further away from our goals than we could have ever envisioned, because now, instead of having money to do stuff to enhance our lifestyle, we're actually like forking out money just to stay afloat. And we're like, holy crap, this is not the vision that we were anticipating. We're like, at 5 years, we're going to travel and do all these things. And I'm like, wow, this is not quite panning out.
And I will say that is typical. It's not that you guys have done anything wrong. It's just I think sometimes we need to have more realistic expectations. We all have certain ideals and plans as to where we want it to be within a 5-year period. But like Tiff said many times, and we've said many times, is it's more of a long-term thing. It's at this year 7 and past where you start really noticing things. But let me just back up here, and I'll give you more what my opinion would be for you to do concrete wise and numbers wise. And what I would do if I were you is I would sit down and figure out, how much am I feeding this property every single month? Okay, so maybe it's $200, $300, $500. I don't know what but each property, what are you feeding it to keep it going? What is your negative cash flow? Okay, and then also look at, how much am I getting in mortgage pay down every single month based on that specific number of rent or whatever you're intending to get. Let's assume that property values increase 1%, 2% over the next year, over the next 2 years, 3 years, 4 years, 5 years. So figure out your concrete numbers as to what your mortgage pay down is, what your negative cash flow is, and how much you feel that the market may appreciate, even if it's a low number. And then you look at it and say, okay, I'm paying down my mortgage by $600 every single month. And
you could very
with
well
property
be paying it down that
appreciation,
much.
I'm getting another $400 or $500 a month. So with those two things combined, let's say I'm just throwing numbers out there, but let's say I'm $1,200 a month is what I'm actually making. And I don't see that in my bank account right now, but that is what I'm making with appreciation and mortgage pay down. And it costs me $300 every single month to make that $1,200. And again, I'm just throwing those numbers out. But when we look at it with concrete numbers like that, then it helps you to make that decision. Is this worth it to keep going? Is this $300 investment I'm putting in every single month, is that worth it for the $1,200 a month I'm going to get later on down the road? And that's where you can start to make that decision.
Perfect. Thank you. That's exactly, we need something that we can.
Yeah, just a model that we can kind of examine here.
Yeah,
no, that's great. Right now, so when it comes to appreciation, I mean, I know it's a gravy thing, right? Like mortgage pay down is the big thing you're looking for. But that thing hasn't moved up a dime in terms of value, right? So I'm just like,
At least it
"Hmm."
didn't lose money.
Well, it didn't lose money, but it's aging. So everything is aging in that thing. So it's losing money in terms of, a washer dryer blows up or whatever. You gotta pay those bills. So that's where it's actually costing us more than I'd like it because it's not getting that in appreciation.
So we have to work the numbers.
We have to work the numbers. I'm just listening to Jen. So I'm gonna work the numbers and we'll figure it out from there.
And that's the first step, is work out those numbers, get definite hard numbers down on paper. And if it's the flip and you're putting in $1,200 a month and you're getting $300 back down the road, then it's a clear answer. Oh no, we should probably get rid of this now. And if it's the opposite, it just helps you to make that decision. But I would work hard on those numbers and get them down pat and then figure it out from there.
Okay, thank you.
Thank you very much.
So one other thing I'd just like to say too, is if you do choose to sell that property, you may want to just market it within Fearless first, because it's a great property, even numbers wise. Like if you were to buy it at today's price, rent it out at today's rents without all the emotion of the washer and dryer blown up and the new floors you had to put and all that, if it's just the numbers, that's actually a pretty nice friggin' property. So I think you could sell it without paying a realtor. That's
you could sell it, or you could also joint venture it out. So instead of selling it and losing 100% of everything in the future, you joint venture it out and you still own 50% and have 50% of all gains and have somebody else take care of the management, et cetera. So and pull out some of your money. So anyways, there's a lot of strategies if the decision is sell. So maybe you guys run some numbers this week, throw it in laser again next week, and we can talk about those numbers and help you make a decision whether it's keep or sell.
That'd be great.
Yeah.
Yeah, love it. Thank you very much, you guys. Thank you.